Trust is dead. This week proved it. While the media focused on earnings reports and policy speeches, the institutions that control global finance executed a series of moves so contradictory, so coordinated, so obviously desperate that they revealed their true condition. They're not managing stability anymore. They're managing collapse, and they're doing it badly. Ladies and gentlemen, Asian guy here. What happened across multiple institutions over the past 7 days wasn't coincidence. It wasn't market forces. It was panic. Coordinated panic by entities that know something the rest of us don't. Or more accurately, entities that know the rest of us are starting to figure out what they've been hiding. The red flags started Monday morning. JPMorgan Chase published their quarterly risk assessment showing record low volatility expectations and stable credit conditions. Standard institutional optimism, nothing unusual. Except that same morning, their proprietary trading desk liquidated $2.8 billion in credit derivative positions. Their public analysis said everything was stable. Their private actions said they were running for cover. Tuesday brought Blackstone's quarterly investor letter praising the resilience of commercial real estate markets and projecting continued growth in property values. Confident institutional messaging. Except that same day, Blackstone quietly suspended redemptions from their flagship real estate fund for the fourth consecutive month. Their words said buy. Their actions said panic. Wednesday delivered Goldman Sachs' economic outlook presentation forecasting controlled inflation and manageable interest rate environments. Professional institutional analysis. Except that Wednesday evening, Goldman's commodity trading division established the largest short position in Treasury bonds in the firm's history. Their forecast said stability. Their position said catastrophe. Thursday produced Morgan Stanley's wealth management guidance recommending increased equity allocations and reduced cash positions for high net worth clients. Standard institutional advice. Except that Thursday night, Morgan Stanley's executive committee approved emergency protocols for client asset transfers to offshore custody arrangements. Their advice said stay invested. Their preparations said evacuation. Friday brought the culmination. The Federal Reserve Bank of New York published research supporting continued quantitative tightening and suggesting inflationary pressures were contained. Official institutional policy. Except that Friday afternoon, the same New York Fed activated emergency lending facilities that hadn't been used since the 2020 crisis. Their research said tightening was working. Their action said the system was breaking. Each contradiction, taken alone, could be explained. Market hedging, risk management, prudent diversification. But taken together, across multiple institutions, in the same week, they form a pattern. The pattern of entities that no longer believe their own public statements. The pattern of institutions that have lost confidence in the system they publicly defend. This isn't the first time we've seen institutional contradiction. But the scale and coordination of this week's divergence between words and actions is unprecedented. These institutions aren't just hedging their positions. They're preparing for events that contradict everything they're telling the public. They're positioning for outcomes that would make their official forecasts look like fantasies. The contradictions extend beyond traditional financial institutions. University endowments that publicly supported ESG investing principles quietly moved billions into defense contractors and fossil fuel companies. Pension funds that announced commitments to sustainable development goals privately acquired massive positions in gold and silver mining operations. Insurance companies that promoted climate risk awareness secretly accumulated strategic commodity stockpiles. The messaging coordination is particularly disturbing. Institutions that compete aggressively in private coordinated their public communications with suspicious precision. Press releases emphasized stability. Investor letters stressed continuity. Conference presentations projected confidence. But their actual positions, revealed through regulatory filings and trading data, told completely different stories. The timing coordination is equally suspect. Why did all these contradictions occur in the same week? Why did institutions that rarely coordinate their public relations suddenly synchronize their messaging while simultaneously taking contradictory positions? The answer suggests either unprecedented cooperation or unprecedented fear, possibly both. Corporate treasuries joined the contradiction parade. Technology companies that publicly endorsed dollar strength and American financial leadership privately established currency hedging programs, assuming dollar collapse. Manufacturing companies that supported free trade policies secretly secured commodity supplies, assuming supply chain breakdown. Retail companies that projected consumer confidence privately prepared for demand destruction scenarios. The mechanics of these contradictions reveal sophisticated deception operations designed to obscure institutional positioning while maintaining public narratives. Internal trading systems were programmed to execute contradictory positions through subsidiary entities and offshore vehicles to avoid detection in standard regulatory filings. Legal structures were created specifically to separate public messaging from private positioning, allowing institutions to maintain contradictory stances without obvious hypocrisy. Professional analysis of institutional trading patterns shows systematic use of derivative instruments to establish positions that directly contradict public guidance. Institutions recommending equity exposure were simultaneously purchasing massive put option positions. Firms advising clients to maintain dollar allocations were building currency hedges assuming dollar devaluation. Organizations promoting financial stability were acquiring credit default swaps, betting on institutional failures. The sophistication of the deception extends to timing mechanisms designed to obscure the contradictions. Contradictory positions were established using different execution timeframes, different legal entities, and different reporting jurisdictions to prevent correlation analysis. Public statements were coordinated through industry associations and regulatory relationships to maintain consistent messaging across competing institutions. Intelligence sources within the regulatory community confirm that standard oversight mechanisms failed to detect the contradictions because they were designed to track individual institutional behavior, not coordinated deception across multiple institutions. The regulatory framework assumes that competing institutions will provide independent analysis and positioning. It was not designed to detect systematic coordination of contradictory behavior across the entire institutional complex. The coordination mechanisms used to execute this week's contradictions required advanced planning and sophisticated communication systems. Encrypted messaging platforms were established months ago to coordinate institutional positioning without leaving traditional communication trails. Private meetings were conducted in non-traditional venues to avoid regulatory monitoring of industry gatherings. Legal frameworks were developed in advance to facilitate rapid coordination when trigger events occurred. The trigger event that activated the coordinated contradiction campaign appears to have been the circulation of classified intelligence assessments showing probability calculations for systemic financial collapse within specific timeframes. Sources within the intelligence community confirm that institutional leaders received briefings showing mathematical projections for currency failure, banking system breakdown, and economic collapse that contradicted all public analysis and official government projections. These classified projections included specific probability calculations that terrified institutional leadership into coordinated action. The intelligence showed 67% probability of major banking failures within 18 months, 43% probability of currency crisis within 24 months, and 89% probability of significant economic disruption within 36 months. These projections were based on data analysis that incorporated institutional behavior patterns, debt level trajectories, and resource availability constraints not included in public economic modeling. Armed with this classified intelligence, institutional leaders coordinated their response to manage public panic while positioning for survival. The contradiction strategy was deliberate. Maintain public confidence through optimistic messaging, while privately preparing for the collapse scenarios outlined in the classified projections. The goal was controlled management of system breakdown rather than prevention of system breakdown. The execution of the contradiction strategy required unprecedented coordination between traditionally competitive institutions. Regular conference calls were established between institutional leaders to coordinate messaging and positioning. Shared intelligence was distributed to ensure all participants had access to the same threat assessments. Joint legal strategies were developed to protect institutional interests during the projected collapse scenarios. But the coordination is breaking down under the stress of maintaining contradictory positions. Institutional leaders are discovering that systematic deception requires more resources and coordination than they anticipated. The cognitive dissonance of promoting policies they privately oppose is creating internal stress within institutional organizations. Employee loyalty is declining as staff members recognize the contradictions between public statements and private actions. Whistleblower activity is accelerating as institutional employees become uncomfortable with the systematic deception they're being asked to implement. Internal documents are being leaked at unprecedented rates as staff members lose confidence in their employer's integrity. Anonymous submissions to regulatory agencies have increased 340% in the past month as institutional employees provide evidence of the contradictions between public messaging and private positioning. The most damaging leaks are coming from institutional communication departments, where employees are tasked with crafting public messages that directly contradict internal analysis and private positioning. These employees have access to both the public narratives and the private intelligence that contradicts those narratives. Their submissions to media outlets and regulatory agencies are providing detailed evidence of systematic institutional deception. Risk management departments are becoming sources of particularly damaging leaks because they possess the internal analysis that shows why institutions are taking positions that contradict their public guidance. These employees understand the mathematical models, probability assessments, and scenario planning that drive institutional decision-making. When they see the contradictions between analysis and messaging, they're providing that analysis to outside parties. The breakdown in internal coordination is creating operational failures that make the contradictions visible to external observers. Trading errors are increasing as different divisions within the same institution execute conflicting strategies. Communication failures are occurring as public relations departments issue statements that contradict positions taken by trading departments. Legal conflicts are emerging as different institutional divisions take contradictory positions in regulatory filings. These operational failures are being noticed by algorithmic trading systems that analyze institutional behavior for pattern recognition. High-frequency trading algorithms are detecting the contradictions and exploiting them through contrarian positioning. Institutional credibility is being undermined not just by their own contradictions, but by automated systems that profit from those contradictions. The regulatory response is becoming more aggressive as the systematic nature of institutional deception becomes undeniable. Emergency auditing procedures are being implemented to force real-time disclosure of institutional positions. Regulatory agencies are demanding explanations for contradictions between public statements and private actions. Criminal referrals are being prepared for institutions that cannot explain their contradictory behavior. The contradiction extends to government institutions. Federal agencies that published optimistic economic outlooks quietly implemented contingency protocols for financial system disruption. State pension systems that announced increased risk tolerance privately demanded physical asset allocations. Municipal governments that projected revenue growth secretly established emergency funding relationships with non-traditional lenders. International institutions followed similar patterns. European banks that supported monetary union publicly acquired bilateral currency swap agreements privately. Asian financial institutions that endorsed global trade coordination established alternative payment systems outside traditional channels. Middle Eastern sovereign wealth funds that maintained dollar allocations publicly accelerated gold accumulation privately. The central bank contradiction is the most revealing. Monetary authorities that projected policy continuity publicly activated emergency protocols privately. Central banks that announced confidence in existing systems established alternative liquidity mechanisms secretly. International monetary institutions that promoted cooperation publicly prepared for isolation privately. This week's contradictions connect directly to the events we've been tracking. The banking rule changes that prioritized institutional survival over customer protection, the $6 trillion exodus from traditional financial instruments, the Swiss decision to terminate international cooperation. Each event broke trust. This week's institutional behavior proves that trust cannot be repaired. The institutions aren't trying to restore confidence anymore. They're trying to manage its absence. Their public statements are designed to prevent panic, while their private actions prepare for collapse. They're attempting controlled demolition of the trust that underpins the entire financial system. But controlled demolition requires coordination and competence. This week's contradictions suggest neither. The institutions appear to be panicking individually while attempting to coordinate their panic collectively. The result is chaos disguised as strategy, desperation disguised as planning, collapse disguised as management. The market response has been confused and contradictory, reflecting the mixed signals from institutional behavior. Equity markets rose on optimistic statements, while bond markets fell on pessimistic positioning. Currency markets strengthened on official forecasts, while commodity markets spiked on institutional accumulation. The price discovery mechanism is breaking down because the information provided by institutions is contradictory. Individual investors are beginning to notice the contradictions. Social media analysis shows increased discussion of institutional hypocrisy. Investment forums are tracking the divergence between institutional words and actions. Retail traders are betting against institutional recommendations while following institutional positions. The credibility gap is becoming visible to the general public. Professional investment managers are caught between institutional guidance and institutional behavior. They're being told to maintain standard allocations while observing institutional evacuation from those same allocations. They're being advised to trust official forecasts while watching institutions position for outcomes that contradict those forecasts. The confusion is spreading through the professional investment community. Regulatory agencies are attempting to address the contradiction crisis by increasing disclosure requirements and accelerating reporting timelines. But the contradictions aren't about disclosure gaps. They're about fundamental disagreement between what institutions say and what they believe. No amount of additional reporting will resolve the underlying credibility crisis. The international ramifications are becoming visible. Foreign institutions that relied on American financial leadership are questioning the reliability of American institutional guidance. Foreign governments that coordinated policy with American authorities are developing alternative relationships with institutions that provide consistent messaging. The contradiction crisis is undermining American financial hegemony. Alternative financial systems are gaining credibility as traditional institutions lose it. Cryptocurrency adoption is accelerating as investors seek alternatives to contradictory institutional guidance. Physical asset ownership is increasing as investors discount institutional recommendations for paper assets. Direct investment relationships are growing as investors bypass contradictory institutional intermediaries. The timeline for resolution is accelerating. Contradictions of this magnitude cannot persist indefinitely. Either institutions will align their actions with their statements, align their statements with their actions, or lose all credibility entirely. The current trend suggests the latter outcome is most likely. The institutional response to credibility loss is predictable. Increased messaging coordination to maintain consistent public narratives, enhanced position management to obscure contradictory actions, expanded regulatory capture to prevent independent analysis of institutional behavior. But these responses only work if the public remains unaware of the contradictions. Public awareness is increasing. This week's contradictions were too obvious, too coordinated, too systematic to ignore. The institutions that spent decades building reputations for reliability and competence just demonstrated that they possess neither. The trust that took generations to build is being destroyed in days. The consequences of trust collapse extend beyond financial markets. Political institutions that depend on financial stability are losing credibility. Social institutions that depend on economic predictability are experiencing stress. Cultural institutions that depend on future orientation are becoming present-focused. The breakdown is comprehensive and accelerating. Emergency protocols are being activated across multiple institutional categories. Financial institutions are implementing crisis management procedures. Corporate institutions are activating contingency plans. Government institutions are preparing alternative policy frameworks. The emergency is no longer potential, it's operational. The question isn't whether trust will be restored. The question is what replaces it. Command systems that don't require trust, control mechanisms that don't depend on credibility, authority structures that don't rely on voluntary compliance. The institutions aren't just losing trust, they're preparing for a world without it. This week proved that institutional credibility is an illusion maintained by coordination and secrecy. When coordination breaks down and secrecy fails, the illusion collapses. What remains is raw power exercised by institutions that no longer pretend to serve anyone but themselves. The red flags aren't warning signs anymore. They're admission of defeat. The institutions that controlled the global economy through trust and credibility just demonstrated they possess neither. What comes next won't be built on trust. It will be built on the ruins of institutions that forgot why trust mattered in the first place. The end of trust isn't coming. It arrived this week. What institutions did proves they know it. What they're preparing for proves they're not planning to earn it back. The game has changed. The rules have changed. The question is whether anyone else realizes it yet.